how the Fed controls liquidity in the markets. And so you kind of wrote this article this week talking about how the Federal Reserve actually supplies liquidity to financial systems.
It really stemmed from last week's article where I talked about what's changed since 2008. It's answering the question, why is the Fed always in the markets now providing liquidity? It was never like that before 2008, except on rare occasion. What we're seeing today, the economy is fine, the markets are doing fine. Why is there stress in the liquidity markets? And the prior article kind of talks about how regulations have changed the playing field and taken it away from the overnight funding markets, away from the private markets, and into the hands of the Fed. How they do that, what tools do they use? Essentially, they do it all through their balance sheet, whether they're taking securities in and putting liquidity out or vice versa. QE, QT are the most well-known. In quantitative easing, they're buying securities from the banks, and in return, they're giving the banks reserves, not cash, reserves. QT is the opposite. Problem with QE and QT is that they're very blunt tools, and they're on a set schedule. So they may say, we're going to do 50 billion a month. That means they're providing or taking away 50 billion of liquidity every month. Prior to 2008, all the Fed cared about was getting the Fed funds rate to trade where their target was. When you have a tool like QE, QT that's constantly adding or taking away liquidity, it's not helping you to target Fed funds the way they used to, where they would just buy or sell every day in open market operations, and they would buy 10 billion, turn around the next day, sell 20 billion. They were doing that to provide liquidity or take away liquidity from the markets to get them to trade the overnight Fed funds rate to trade where they wanted to trade. Since then, they've created a bunch of facilities, for lack of a better word, that have created what's called a corridor. And the corridor is a floor and a ceiling on Fed funds. So essentially, what it does is it keeps Fed funds within a range, which is what the Fed wants. It has basically lending facilities when Fed funds get too high, and facilities where investors can invest their money when it gets too low, and it keeps Fed funds about where they want it. But in the process, what it's created is a signal to the market. When these rates get disjointed from where they should economically, financially make sense trade, that's how you know you have some stresses going on. So this corridor system, in theory, should work, but as we find out in the markets, there's always stresses, whether that's because banks just don't want to lend money because they have capital issues, whatever the issue may be. These corridors that they've set up are also alarms for us to use. The Fed is the provider of liquidity. Every market, stock market, Bitcoin market, gold market, even the commodity markets, they depend on liquidity. That's one of the big drivers of price. That's why we spend so much time talking about the Fed.
Catch me daily on The Real Investment Show. The link is in the description.